For weeks, headlines and social media have been buzzing with one claim: the World Cup might leave the United States. But when we look closely, the facts don't line up. Independent fact-checkers like Snopes and major outlets such as Reuters confirm there is no official evidence to support this rumor. The schedules, the contracts, and the investments remain in place. Still, the very idea sparks fear. If such a massive event were to move, what would it say about America's stability? And here's where the story connects to today's bigger picture. As Trump Tariffs 2025 dominate global business discussions, investors are already questioning how policy shifts could affect market confidence. So the rumor becomes more than just sports chatter. It touches the heart of financial trust. If the World Cup is not leaving, then what are the real risks that investors should be watching? That's the question we will explore step by step in this analysis. FIFA and the White House. Commitment, not retreat. When FIFA President Gianni Infantino left Washington earlier this year, his message was clear: the world will be welcomed. That statement was not a casual remark. It was a public assurance backed by meetings with U.S. officials and reinforced by diplomatic commitments. For investors, this is a key signal. Despite loud rumors online, the White House has moved in the opposite direction, working to strengthen guarantees that the United States will remain a central host. Political capital is being spent to reassure allies, trading partners, and especially fans who are already planning their trips. At the same time, reporting from the Associated Press highlights a new layer of accountability. FIFA has required each host city to submit human rights protocols covering labor standards, housing, and anti-discrimination measures. This framework shows preparation is not slowing down. It is accelerating. Instead of planning an exit, U.S. cities are locking in compliance, adjusting policy, and aligning with FIFA requirements. For Wall Street and Main Street alike, the signal is straightforward. The World Cup is not moving out. It is being reinforced with stronger governance. Investors should read this as commitment, not retreat. $625 million federal security backstop. Security is often the first question investors ask when it comes to mega events, and the World Cup is no exception. In August, Politico reported that Congress approved a massive $625 million security package for the 11 U.S. host cities. This isn't free cash or a political slush fund. It is structured as a reimbursement system, meaning local host committees must submit receipts, invoices, and proof of spending before federal dollars are released. That design adds layers of accountability while ensuring every dollar is tied directly to security operations. For cities, it covers overtime for police, emergency planning, and advanced surveillance technology. For the federal government, it is a signal of seriousness. Washington is not just promising safety, it is financing it. And for investors, this matters more than headline politics. Tail risk, those low-probability but high-impact shocks tied to security, has always haunted global sporting events. By putting real money on the table, the U.S. government is showing confidence that it can host safely and deliver without disruption. The takeaway is simple. Markets dislike uncertainty, but a $625 million security backstop cuts into that risk. It demonstrates commitment at the highest level and strengthens investor trust in the U.S. as a reliable stage for the World Cup. Queues, delays, and the AI solution. For all the talk about stadiums and sponsorships, one of the most practical risks facing the World Cup is simple: visas. According to Reuters, current wait times for U.S. tourist visas stretch close to 400 days in Colombia and around 200 days in Mexico. That means a fan could book a ticket today and still not have documents in hand by the time the tournament begins. The implications are serious. If fans cannot secure entry in time, airlines risk flying with lower load factors and hotels risk missing out on peak occupancy and higher average daily rates. This is not just an inconvenience. It has direct revenue impact across travel, hospitality, and local retail. The U.S. government is aware of the problem. Officials are considering expanding consular staff and experimenting with AI-assisted document processing to cut through the backlog. For investors, this issue needs careful framing. It is a short-term operational risk, not a systemic threat to America's economic stability. It can pinch revenues in certain sectors, but it does not equate to a collapse of investor confidence. In fact, this is where context matters. As Trump Tariffs 2025 continue to reshape trade headlines, global markets are already on edge, scanning for signals of weakness in U.S. systems. Visa delays amplify that sense of fragility, but the response, hiring staff, deploying new technology, shows that the U.S. is not standing still. The bottom line, investors should see visa processing as a logistical hurdle, not a reason to question the entire U.S. market. The sun, not the sight. When the Club World Cup wrapped up earlier this summer, players and coaches had one common complaint: the heat. Matches played in the early afternoon saw temperatures soar, creating health risks on the pitch and visible frustration about field conditions. Grass dried quickly, energy levels dropped, and performance quality suffered. This experience raised an obvious question. What happens when the World Cup arrives in 2026? The good news is that solutions are already on the table. Scheduling matches later in the evening is one step, allowing cooler conditions and better recovery times. FIFA has also confirmed that cooling breaks will be part of the official match protocol. Perhaps most importantly, host cities have an advantage many fans overlook: roofed stadiums. According to ESPN and Reuters, venues in Dallas, Atlanta, Houston, and even Vancouver can close the roof and activate advanced cooling systems. That means the United States and its partners are not scrambling for alternatives. They are leaning on infrastructure already in place. For investors, the key takeaway is clear. This is a logistics challenge, not a location crisis. Adjusting match times and using roofed venues are tactical solutions that protect both players and revenue. The rumor of the World Cup moving out misses the point. What matters is adaptation, and the systems are already being deployed. The heat may be real, but the commitment to host remains even stronger. Miami's deficit, New York's big bet. Not every host city views the World Cup through the same lens, and that divide says a lot about local economics. Take Miami-Dade County. Officials there have committed roughly $46 million in cash and in-kind support to host matches, even as the county faces a significant budget deficit. Critics argue the money could be better spent on public services, and taxpayers are questioning whether the short-term costs will outweigh the long-term gains. The debate is sharp, reflecting anxiety about how much financial risk a city should absorb just to be on the global stage. Now compare that to the New York, New Jersey region. Analysts project a staggering $3.3 billion in economic impact tied to World Cup hosting duties. Local leaders frame it as an investment in global visibility, increased tourism, and job creation that could ripple across the region for years. Instead of hesitation, the tone in New York is one of confidence, betting that upfront spending will translate into outsized returns. For investors, these contrasting stories offer valuable insight. On one side, Miami highlights fiscal caution and the political risks of spending in a deficit environment. On the other, New York demonstrates aggressive optimism, channeling resources with the expectation of major payoffs. The common thread? Real money is flowing now, not just promises. And that flow of capital is the ultimate vote of confidence. It signals that while some regions worry about costs, others are doubling down, convinced that the World Cup will deliver. For markets, the message is clear. Investor trust is reflected not in rumors, but in the dollars already being deployed. From Comcast bundles to hotel bookings. When it comes to investor confidence, the clearest signals often come from the private sector. Consider Comcast, one of America's largest media and telecom companies. Just weeks ago, it launched the World Soccer Ticket, a bilingual bundle in English and Spanish that packages World Cup broadcasts across its platforms. This move shows that corporations are not waiting for clarity. They are building products and revenue streams around the certainty that the tournament will be played on U.S. soil. The hospitality sector is also sending strong signals. Data from STR's Forward Star shows hotel bookings rising ahead of key matches and host city announcements. The increases are not uniform. Some cities with roofed stadiums or prime match slots are showing bigger gains than others. That uneven demand reveals a crucial insight for investors. It is not about the headline question of U.S. versus no U.S. It is about city rotation, where covered venues and attractive fixtures generate higher occupancy, stronger average daily rates, and ultimately stronger profits. For the stock market, this translates into sector plays rather than broad market swings. Hotel chains like Marriott and Hilton could see localized upside. Airlines like Delta may benefit from stronger transnational travel flows. And media companies like Comcast are positioning themselves to capture subscription growth and advertising revenue. The lesson is clear. Corporate America is betting on the World Cup, not backing away. Markets are reading those bets and pricing opportunities city by city, sector by sector, rather than doubting the event itself. That is what real investor confidence looks like in practice. Base versus adverse. What do investors price? When investors look at the World Cup today, they are weighing two scenarios, one overwhelmingly likely and one far less so. The base case, carrying about a 90% probability, is straightforward. The tournament stays in North America as planned. Yes, there are operational risks, visa delays, security costs, extreme summer heat. But each of these is being mitigated through staffing, technology, and scheduling adjustments. In this world, investors price city-by-city opportunities, stronger hotel rates in New York, higher airline traffic into Dallas, and bundled media revenue for Comcast. Confidence is intact, with risks viewed as manageable. The adverse case, at roughly 10% probability, looks very different, but still falls short of the World Cup leaves America rumor. Instead, it would mean adjustments within the U.S. and Canada. Games could be shifted toward roofed stadiums, or kickoff times moved further into the evening to beat the heat. This is not a withdrawal scenario. It is an internal reshuffling. For markets, the impact is more about revenue redistribution than destruction. Some cities might lose out on hotel demand or retail surges, while others gain. For publicly traded companies, the effects are sectoral rather than systemic. Hospitality, airlines, and media all adapt, but the S&P 500 itself does not face a meaningful shock. And here is the mid-hook that ties today's headlines together. If Trump tariffs 2025 stay while visa queues persist, do markets rotate to safe plays or overreact to noise? That question captures the balance between real operational issues and investor psychology. For now, the evidence shows investors are leaning toward resilience, not panic. As we close this analysis, the question for investors is not whether the World Cup will leave the United States. It won't. The real question is, What data points matter most over the next 2 months? First, watch visa processing times. Consular data will reveal whether backlogs are shrinking and whether fans from key markets like Latin America can realistically arrive in time. Second, track the $625 million in federal security funding. The speed and transparency of disbursement will show whether cities are ready to execute on safety at scale. Third, keep an eye on the official match schedule and kickoff times. Adjustments for heat or stadium logistics could shift demand from one city to another. And fourth, follow STR's hotel booking compression nights, particularly in roofed cities like Dallas, Atlanta, and Houston. Early booking spikes are often the clearest forward indicator of local economic lift. Together, these four signals offer a sharper lens than rumors ever could. For investors, they turn speculation into measurable benchmarks. And they also anchor expectations in hard data, rather than online noise. Because here is the truth. Investor confidence is not shaken by social media chatter. It is shaped by the flow of capital, the readiness of infrastructure, and the resilience of governance. Even in a world of trade headlines and Trump Tariffs 2025, market psychology is built on numbers, not rumors. So the message is clear. Follow the data, not the drama. And if you found this breakdown helpful, don't forget to subscribe, like, and share so you can stay ahead of the next critical signal.